79% of companies have surpassed every profit target that Wall Street has set. Yet your weekly grocery bill costs about $20 more than it did last year. It makes you wonder, is the cash register malfunctioning, or is the market in a parallel universe? We seem to be trapped in a financial illusion, don't we? Stick with me for the next 10 minutes as we unveil the great financial illusion of 2025. What we discover may astonish you. Why? The profit mirage. Let's begin with the obvious, earnings. They appear remarkable at first glance. For instance, Q2 profits for the S&P 500 surged by an astonishing 10.4%. That marks 3 consecutive quarters of double-digit growth, rare territory for any market. Analysts are forecasting record earnings per share for 2025, with even brighter predictions for 2026 and 2027. When investors witness such impressive figures, they rush to buy, and stock indices soar higher. Seems straightforward, right? Good earnings lead to an uptick in stock prices. But wait, not so fast. There's an important detail lurking just beneath the surface. Those attention-grabbing profits? They are inflated thanks to a select few companies that we refer to as the Mag 7 tech giants. These aren't just ordinary companies. They are giants, and their astonishing growth can distort the overall market perception. If you exclude their contribution, you will see that the rest of the market has mostly stagnated. Consider this analogy. Imagine a classroom where 7 students always get A's on exams. They raise the overall average, making the school look exceptional. However, what about the rest? Many others are barely managing to scrape by with C's or lower. While the report card shines brilliantly, a closer look reveals a different reality, and that reality is becoming increasingly grim. While the tech giants continue to excel, the broader economy shows signs of distress. Manufacturing output is slowing down significantly. Surveys of consumer confidence are nosediving, revealing that many feel insecure about their financial futures. And what about GDP? A sluggish projected growth of just 1.6% this year represents a notable decline from the previous cycle's 2.8%. This slowdown is a clear indication of broader economic challenges. So, why does the stock market keep rising? It's because the S&P 500 and other major indices resemble price-weighted popularity contests, lacking a true reflection of national economic health. When a single company like Apple adds $300 billion in market value, it can push the S&P 500 higher, even if local factories are closing and laying off workers. The market is measuring something very different from people's everyday realities. The Fed put that refuses to expire. Now let's delve into the second reason for this confusing market behavior. The Fed, specifically the enduring influence of its past put. Traders have spent years believing in a safety net. The unspoken agreement was that if things got tough, the central bank would step in with rate cuts or other supportive measures to stimulate buying. This ingrained expectation of Fed intervention fuels risk appetite, prompting investors to take greater risks while relying on Fed backing. However, warning signs are emerging from various sectors of the financial world. Long-term Treasury yields, typically stable, are behaving unusually and the dollar seems unstable. This isn't standard. Historically, when bond yields exhibit such erratic behavior, stocks tend to react negatively, signaling trouble ahead. Yet the current sentiment is that bad news is good news. Any hint of economic instability is considered a sign that the Fed will cut rates, thus providing more support for the market. This creates a self-perpetuating cycle. Weak economic data leads to anticipation of rate cuts, driving stock prices up. It's a precarious game where the market is constantly testing the economy's resilience, hoping for a Fed intervention. Buybacks, the quiet bid. The third factor in this financial illusion is corporate buybacks. Companies flush with cash from seemingly impressive profits are repurchasing their own shares at record levels. Why is this significant? It's economic sorcery. When a company buys back its shares, it decreases the total number of shares available in the market. With fewer shares in circulation, the same profit now translates to a higher earnings per share, EPS. Voila! Higher EPS leads to higher stock prices, all without any real business growth or additional product sales. It's a potent strategy that works brilliantly until it doesn't. Picture it as a company slimming down by consuming its own tail. The brokerage statement shows a lower weight per share, which looks appealing. However, the company's underlying strength hasn't really improved. They haven't innovated, become more efficient, or gained market share. They have merely shuffled numbers around. If revenues plateau, or if high interest rates make borrowing for buybacks costly, that buyback machine grinds to a halt. When that occurs, reality hits hard, and stocks become susceptible to swift corrections once investors realize the growth wasn't genuine. Tariffs and the inflation squeeze. Let's address an often ignored but crucial factor: tariffs. Currently, tariffs are at their highest since the 1930s. These aren't merely abstract policies. They are stealthily inflating the prices of everything, from cars to canned food. This hidden burden takes a toll on household budgets, providing consumers with less disposable income. Yet the stock market remains largely unconcerned. Why? Because mega corporations have largely succeeded in passing these costs on to consumers. You spend more, their revenues rise, profit margins remain robust, and their stocks rejoice. It's a clever strategy, provided it can be maintained. But here's the catch that could disrupt this delicate equilibrium. If the economy shifts even slightly, if consumer spending falters, or if competition intensifies, companies will lose this pricing power. They will have to absorb the tariff costs, which will lead to a grim outlook for profits. Traders who eagerly chase the rally will quickly pivot to a panic sell. Until that turning point, tariffs act as a hidden tax that paradoxically creates the illusion of corporate growth, even as they erode the purchasing power of everyday Americans. It's a ticking time bomb. Concentration risk in plain sight. Next, let's turn our attention to concentration risk, which is glaringly obvious. A handful of heavyweight tech firms now constitute about 1/3 of the S&P 500's market value. Consider that for a moment. Even at the height of the dot-com bubble in 2000, the top 7 companies held a smaller portion of the market. This isn't merely a slight skew, it's a significant imbalance. When just a few stocks control market direction, any misstep, a major antitrust ruling, or an unexpected supply chain hiccup can trigger widespread volatility. And diversification? That concept has nearly become outdated as investors flock to the same popular tickers: NVDA, AAPL, MSFT, GOOGL, AMZN, META, TSLA. Who can blame them for seeking these winners, especially given their recent performances? Yet this creates a fragile market infrastructure. Picture a bar stool with all its weight on 1 or 2 legs. If one leg falters, the entire stool collapses. That's the moment index investors, those passively riding the trend, learn that passive doesn't equate to safe. Instead, it means you're exposed to the concentrated risk within that index. And currently, that concentration is alarmingly high. So what should you actually do? We've unveiled the curtain behind this financial illusion. So what should you actually do about it? How do you maneuver through a market that seems detached from reality? Firstly, and most importantly, take a broad view. Markets operate in cycles, some exhilarating and others frightening, but your financial future extends over decades. Don't allow short-term volatility to dictate long-term decisions. If you can't identify a sound, fundamental reason for owning a specific asset beyond mere price momentum or hype, it means you're at its mercy. Secondly, evaluate your exposure critically. If any single market sector or the dominant 7 stocks collectively surpass 20% of your investable wealth, it may be time to downsize or hedge. Consider reallocating some gains into sectors trading under 20 times their free cash flow with consistent dividends. Think utilities, midstream energy, and select industrials. They might lack the glitz of growth stocks, but often deliver reliable cash flow, offering stability in turbulent markets. In a fluctuating environment, the mundane often outperforms the risky. Thirdly, maintain a shopping list for the inevitable moment when the illusion shatters. Cash available buys you more opportunities, rather than instant noodles during market downturns. Identify high-quality companies that you believe in for the long run, but whose valuations currently leave you wincing. Set buy limit orders 15 to 20% below current prices for those companies. Volatility often delivers these opportunities quicker than anticipated, allowing you to acquire quality assets at steep discounts. Lastly, and this is crucial, avoid trying to time the market bottom, a nearly impossible task. Instead, consider consistently dollar-cost averaging into a broad, low-cost index fund. This approach smooths out your purchase price over time and reduces emotional investing. Simultaneously, keep 3 to 6 months' worth of living expenses saved in a high-yield account. This financial buffer provides peace of mind. By following these steps, you will find that you can rest easier, and your future self will appreciate your discipline and foresight. If this analysis helps you grasp this complex market, please hit that subscribe button. Don't miss next week's deep dive on how the presidential race could dramatically impact the tariff situation we addressed. Also, check the description below for a free earnings quality checklist I personally consult before adding any new investment. It's a real game changer. Red flags to watch right now. Beyond these foundational strategies, remain vigilant about specific red flags. Closely monitor trucking tonnage, weekly unemployment claims, and the ISM Services Index. These metrics serve as potent coincident and leading indicators. Truck tonnage reflects real-time economic activity, weekly unemployment claims reveal labor market strength, and the ISM Services Index depicts the vast services sector that comprises much of the economy. A simultaneous decline in all three metrics could signal rapidly worsening corporate guidance. Additionally, keep an eye on the 2-year Treasury yield. A sharp, continuous decline often precedes major layoff announcements, which subsequently affect consumer spending in a short time frame. This serves as a significant warning signal for economic contraction. Lastly, pay attention to buyback blackout windows. Companies frequently halt share repurchases ahead of earnings reports. When these windows close, the artificial demand we discussed earlier vanishes, typically leading to increased market volatility. This phenomenon usually occurs during the second week of January, April, July, and October, just before most firms release their quarterly results. Utilize these moments to evaluate your positions and strategy rather than chase the fear of missing out. It presents a prime opportunity for the market to reveal its genuine sentiment without corporate support. So let's be clear. The market's current highs aren't entirely fake. They are real but are sustained by the outstanding earnings of a few tech giants. These gains are bolstered by record corporate buybacks and an unwavering trust that the Federal Reserve will intervene when needed. Meanwhile, the broader economy struggles amid tariffs, diminishing output, and squeezed consumers. This disconnect, this illusion, can last longer than even the most seasoned skeptics expect. However, history shows us that such divergences usually correct through price rather than time. Eventually, valuations align with reality. Your responsibility as a prudent investor isn't to predict the peak. That's a fool's endeavor. Rather, your goal is to not fall prey to sentiment shifts when they finally occur. Accumulate cash reserves, diversify away from the overload of mega-cap stocks, and let data rather than sensational headlines guide your decisions. By following this approach, you won't just navigate this great financial illusion. You'll be strategically prepared to seize genuine value when the market eventually offers it at a discount. That's how you transform illusion into opportunity. If you found this insightful, please hit that subscribe button. Share your biggest market question in the comments. I enjoy hearing your thoughts. Don't forget to watch the next video on reading an earnings report in under 5 minutes. Because when the illusion fades, fundamentals will be all that truly matters.